You want to make a bit more bread? Don't want to work until you're dead. So come and listen ahead and find some other ways instead.
Hello and welcome to the 7th episode of the Financial Freeman podcast.
7.
My name is Gary Freeman. I'm a former lawyer, you threw me off my track there, and finance educator and investor.
And I'm Ronnie Freeman, and I'm a property developer, an artist, and his better half. And we're here to financially educate you, and we will start with the news story of the week.
And this story is all about a retailer in the United States called Target. They have stopped selling Pokemon cards.
I didn't know places were still selling Pokemon.
They did until I saw this story. And the reason they've stopped selling is because there was a fight, a gunfight in one of their car parks, because I suspect one of them must have had a card that was
a good one.
Yeah, shiny. Because shinies are now very, very, very popular and are going up in price. So one card recently sold for $300,000, I don't know if it's dollars or pounds.
Whoa.
And a box little set sold for I think $400,000. Again, I'm not sure if it's pounds or dollars. When it was only worth about I think $30,000 a few years ago. So these little Pokemon cards are going up in value.
We had my brother round for dinner.
We did. What happened?
And Gary shared the news story of the week because it's such good dinner party conversation.
Yeah.
And he has his original Pokemon cards. 20. How old is he? It must be over 20 years ago. The first editions. And he got quite excited and he started looking at what they're going for on eBay. And some are worth hundreds, some are worth thousands. So he left the dinner party. We're going to sneeze.
Oh, this is literally keeping you in suspense. What happens next? Dum dum dum.
Bit of sniffling. He left the dinner party, went to my mum's loft, which is where his cards are, and to see what he has. And he's got most of the set bar a few. Six. So yeah, he's going to do more research, but he's a fair bit richer. He will be when and if he sells.
So that was our education to him. But that's the story basically, that these things, because they're rare, and you might remember from last week's episode where we talked about things that are rare, they're now going up in value, and they're not making any more. So obviously these are old cards.
So how are Target getting them?
I think they're just selling, they're not selling first edition anymore.
Right,
But
so
they must have been selling something that was still they thought was valuable. I didn't read fully into the story.
Maybe you should if you say
it to the millions. But yeah, that's the story, and it's just a note to say these things are still going up in value. Assets that is now an asset. Pokemon card, you may not have thought about it, but it obviously is. And so there's other things to invest in, not just property and shares, which are the two of the main things we've covered so far, but obviously cryptocurrency, which we covered last week. But it could be art, it could be fine wine, whiskey, or Pokemon.
Don't throw away your childhood toys. Just don't, because you just never know.
Well, unless it's like a rubbish bit of tat from China.
You just never ever.
That's never going to go up in value. The China tat.
Well, you never know. China might explode, and then everything made in China will become
too much. It's almost like as many Joji coins. It's just too much of the plastic stuff for it ever to be. But anyway, keep your toys if that's what you want to do.
Don't keep your toys.
Yeah. That's the moral of this podcast. So on to this week's topic, which is the question really is, should you invest now? Lots of people don't invest now. Well, that's the question. Is there a bad time? Is that what you're going to say?
Yeah.
Right, exactly. And lots of people don't because they say, Brexit, or everything's going down at the moment, I'm going to wait. And then conversely, those same people then say, oh no, it's just going up at the moment, I don't want to buy it when it's going up, I'll wait till it comes down again. And I have heard the same person say the same logic, which is when
Good
you
logic.
it is good logic. You can see why it works. They're too scared when it's going kind of down, and too scared when it's going up because they think they should have bought in when it was cheaper. So, is there ever a bad time? I mean, this is how we were going to end up, but we can start on this, which is that possibly on any individual asset there is a bad time. Um, Assets go up and down, property prices go up and down, shares, certain individual shares go up and down. So yeah, if you're buying that whatever asset it is at its peak, and clearly that is the wrong time to be buying it. Now we don't know when that peak is in any given moment, so
it's all good in hindsight.
yeah. But I think overall, in terms of is there ever a bad time to invest as a general, the answer I think is no. There will always be something good to invest in. And when I'm talking about is there a good time, I'm talking about sort of across the board and when should you start. So I'm not saying is there ever a good time to invest in gold or Dogecoin as we talked about last week, because then there might be a good time or there might be a bad time. But in terms of when to invest, I guess with a capital I overall, then we have to. I think the answer is there's never a bad time, and you should get cracking. And there's a couple of main reasons.
Day before a crash.
Yeah, so if you become educated and you are familiar enough with the cycles, then you may
Which cycles?
With general market cycles, for example. If I'm talking now maybe on shares predominantly, but you could be talking about property. All asset classes have cycles, and you were learned enough, let's say, to um, that a crash was really imminently coming, then you wouldn't then put your money in knowing that it's going to fall the next day. The thing is, what we're saying there is you probably wouldn't know. So even in that scenario, I would say, well, why don't you put a bit in and maybe average it out over the next 12 months, rather than not putting any in at all, because you just don't really know when the top or the bottom is going to be. So even in that scenario, you'd be saying, well, you might still miss out on 6 months growth by not investing because the crash that you think is going to happen might actually happen, but it might be a lot further down the line than what you would have expected. So even in that scenario, you may have been better off actually putting in 6 months ago because it might go up so much in that time in the next 6 months that even when it crashes, it might there's month one, goes up, so it sits to month six, and then it crashes and it goes down to that there. So actually, you were better off investing because there's after 6 months and there was before. That makes sense?
It's a beautiful diagram.
Thanks. The cardboard box.
It wasn't even a straight hand.
No, well, okay. There's the cupped hand, but I think hopefully it helped our viewers kind of appreciate that. I don't think there's ever really a bad time, but there may be a bad time to kind of go into individual asset or to kind of go all in on anything because have some reserves, because you never know what might happen. So with that in mind, there's two main reasons why I think that's fairly sound educational tips, and the first one is we've touched on it before.
By the way, the Spotify listeners won't be able to appreciate you.
My hands, okay. They'll have to contact us separately. Gary.financialfreeman@gmail.com for if you want a personal one-to-one Skype call, so I can run through the clause, but it's probably worth doing. The first main reason, it was touched on it before, is the compound effect. You've read the book, but what it didn't touch on in that book is really kind of the compound effect when it comes to investing. And I want to run through an example, and it's actually quite a good real life example because it's fairly low, starts out fairly low sums, and as you'll see, kind of turns into huge pots. Because someone else has said a few people have said to me in the last few weeks, they've said, well, this is all right for someone who's got lots and lots of money, or your stuff that you're talking about, but what happens if you can't put away a lot of money? And I said, well, yeah, but the same principles apply. Yeah, it might take a lot longer. If you did want to retire, let's say, you may only be shaving off 5 years or so if you can't put away a lot of money. but that's 5 years potentially less working doing something you may not be wanting to do. So it still might have an effect. Obviously, it might have a less of an effect if you've got less inputs to begin with. But don't just dismiss the idea because it can still have an effect on much smaller amounts. So the example I've got is, and I've just done a note, so don't mind if I take that out, is basically starting out with a pot of £5,000. Okay, that's your investment pot, and every month you are able to save £250. Okay, which obviously might be an awful lot of money to some people, less so for others. But on the average wage, I think that works out as about 13% of your monthly take-home pay, which again is obviously quite a lot for some, but I think it's doable, especially if you cut down on those dinners out with your friends. So you've got your £8,000 after year one. Okay. Now, if that money is sat in your bank account, okay, interest rates at the moment are effectively zero. You don't get any money in the bank. Boo, big boo. You get negligible amounts, but for the purpose of these calculations, we'll call it a big fat whopping zero. So after year one, 8,000 at 0% interest. What have you got in the bank?
8,000.
8,000. Right. Okay. So now, what we're going to do now, there's going to be loads of people that complain about this, but we're going to say that if you were to invest that sum of money, you're going to make 8% every year.
What the average was 10.
The average over the S&P 500, which is the top 500 companies, is 10%. That's going back, I think, about 90 years, which is obviously high. There is...
My 8% then.
That is, well, there's loads of figures bounded about. So Warren Buffett famously said, he's one of the famous investors.
I've heard of him, yeah, thank you.
That you should use, I think, it's between 6 and 7 as the barometer.
But you just went for 8.
I've gone for 8 because actually I've gone back to the index in America, wider than just the S&P 500. The return there, it's called the Dow Jones, has returned roughly about 8% going back since whenever they began. So you could argue whatever percentage it should be, but I think for the purpose of this, I'm going to use 8%. Now, it's obviously important to stress that in any given year, you're not going to get 8%. It's an average. So one year might easily be 15%, but obviously the next could be a lot lower. So don't just assume that if you're in the market and you've got money to invest for 1 year, then you need to go and buy a new kitchen or what have you, that in that year you're going to grow 8%. It just doesn't work like that. This is over longer term averages, and obviously even again, past performance is no guarantee of future guide, so it suddenly might not be 8% for the next 5-10 years. But we are assuming for this purpose that it's going to match the historical averages of 8%. So well done if you do that. Now after year one, you get 8,584. Now again, it's probably not quite as close to this because you're not having that money in the market the whole time, but just work with me here because there's no kind of exact science to it, but I just kind of want to see the power potentially of the numbers. So you've suddenly gained £584 if you invest rather than keeping your money in the bank. Can you retire from that? Probably not.
Can you what? Not?
Retire from that, but it's a start. Okay. Now the key thing is here though, is that at the end of this year, first of all, you keep putting your £250 in, but the second thing is that £584 gets invested still. You're not taking the money out because you don't need this money for anything. So you don't need it for your new kitchen. You're able to keep that.
You've got a nice kitchen.
Yeah, very nice. Sounds like it was that mindset thing. Like at night, you have got a nice kitchen. I don't know if anyone struggles from sort of on the confidence of not a nice kitchen, but anyway, you get your £584.
Well, just accept that you're not going to get a nice kitchen.
Oh yeah. Well, you might after all of this, actually. Just got to wait a bit longer. So that gets reinvested in the market. So that's then gaining 8% as well. And this is where your money starts to snowball. So rather than it making 0% in the bank, it's making money from the money. So 5 years, okay, at this point, the saver has £20,000 because he's built up his original 5k and £250 a month for 5 years.
5, 8, 40.
So how much do you think
Wait, how much has he got?
The saver has 20,000.
What? He's 8k a year.
He's getting £250 a month.
8k a year. over 5 years.
He's not getting 8. Where's he getting 8k a year? He's only making £250 a month.
What did he invest originally?
5k.
Oh, right.
Right. So he's got 20,000.
Well, 5 years he should have 25,000.
No, 20,000.
5k times 5.
Where's the 5k from?
I thought he was putting in 5k a year. No.
No. 5k was the original sum,
Oh, right.
and then after that he's putting in £250 a month.
Okay.
So he's got 20.
Swapsies.
No, he's got an original investment pot.
Okay.
And then after that, he's able to save £250 a month from his job. He just has the 5k that he's been sitting there for a few years. How much do you think so the saver has 20,000, he doesn't get any interest after 5 years. How much do the investor has then?
What?
The saver, the money in the bank, has the 20,000.
Oh, he's got 20,000.
Yeah, how much does the equivalent, because he's been investing for 5 years?
5 years, 8% a year.
Just guess.
35,000.
Okay, not as good. 26,000.
Oh.
Okay.
So you're going to work magic.
No, I'm going to soon. So he's gained 6,000 from his 5 years. Good, not amazing. But the key thing is that 6,000 is being reinvested. So he's making 8% the year after on that 6,000. Okay, work with me. 20 years. Okay. The saver has 65,000. Okay.
100,000.
This is where it becomes magic.
250,000.
173,000. So after 20 years, this is when the huge growth comes at 8%. Okay, you're suddenly gaining over £100,000 by investing as opposed to saving. Okay, so that's
right.
And that, if you're starting as a 20-year-old, is very, very powerful. Which is why they always say start earlier. Okay, because it can have a huge effect, and that's on these numbers. You may be able to put in more. Okay, in which case, obviously, the numbers kind of go a lot higher. So 30 years, okay, this is the real key. So if you're starting out as you're a 20-year-old, you invest for 30 years, instead of retiring at currently 68, you want to retire, your target is to retire at 50 years. Can you do that? That's the real question. So the saver has 95,000 after his 30 years. How much does the investor have?
What did he have before? 100 and what?
He has 173 after 20 years.
302.
430. Okay, so that's the key. You've gone from 95, less than 100 grand, to 430 just by investing. And actually, one of the reasons what Warren Buffett says he's so successful is that he says it's because he's just stayed in the market.
And he's old now.
And he's old, and that's how he's made so much money. Yes, I'm sure he's fantastic at investing and principles, but it's very difficult. But what's possibly less difficult is just to stick around, and that's really what he's done. So that's the number one reason why net investing today is worthwhile. There are other reasons. One of them really is, as I just said before, there's two. The second one I think is tax. So each year, for example, you get £20,000 of what they call an ISO allowance. And I think we'll probably have a podcast on sort of the tax regime when it comes to investing, because it's very complicated. But certainly when it comes to shares, you are allowed to invest £20,000 and your gains are tax-free from that, which is pretty powerful considering if you're a higher rate taxpayer at work, you're paying 40%. Yes, you get 20,000. So if you don't start until next year, you lose this year's £20,000 that you can invest in. You don't get it back. You don't get to double up to 40,000 next year. So it's a good reason to start investing.
Why do we do that?
I think to incentivize you to invest. Really, I'm just trying to think what's the rationale, but it's good for business. But it's a good question. I'm going to write that down. And I think we'll go on the tax when we do the tax podcast. We'll answer that kind of query. Why do they incentivize you? Because actually, as we'll come on to, generally tax system is still favourable to invest. Even though there have been changes in recent years, but it's still more favourable than working, for example. And I think the third sort of lesser but still important reason is that it's enjoyable, and it can lead to other
What's
things.
enjoyable?
Investing,
Is it?
because you learn. Well, I enjoy it. You learn a lot from it. It becomes like a game.
Some days.
Yeah, but it becomes like a game of Monopoly, really, and you could just
You like
talk about
Monopoly?
it. Yeah, if you like Monopoly, it's not probably not for everyone this, but for example, it can become your brother was fascinated by the Pokemon, so that's investing. As long as you're investing in something you are interested in, then actually I think it's probably something for everyone. I'm not saying go to property, but only if property is something that you find fascinating. But I'm sure there's if you're an art dealer, then you'll find art fascinating potentially. But there's probably an asset investment class out there that actually you are finding fascinating, and so there is the enjoyment side, and I think the other thing is you're learning more. So you may not be the best investor in year one, but I think as Warren Buffett said, he's grown in time, and so you've got to start somewhere. So start, and then maybe not don't risk maybe the crown jewels, but just start dip your toes in and kind of build up that knowledge base, and then later down the line you'll hopefully become a better investor and make even more money. You might then beat the market average for tomorrow for 8%.
Warren Buffett.
No, you might not beat Warren. Well, you could beat Warren. If you beat him consistently, you're doing very well. But you might certainly beat the 8%, which is the average we're talking about. And the final thing is really, you don't know where it's going to lead. When we started investing, I didn't think I'd be doing a podcast, for example. And there's other things that have happened as a result. So it just might open your eyes, like, why not spend time doing something hopefully that you enjoy and that is clearly interesting, as opposed to wasting that time potentially doing something else. So start doing that as well. Does that answer your question? Is there ever a bad time to start? Happy?
I don't think it was my question.
Yeah, you said it at the start.
Did I?
Yeah, that's what you came in as, yeah.
I got told to, so.
All right.
It wasn't authentic.
No.
It was his question.
Right. Oh, well, okay.
It was a good answer.
Happy?
Nevertheless.
Good.
Always happy. Don't forget to give us a subscribe, give us a like, give us a follow, give us a thumbs up, or whatever you want to give us. Slap in the face. You can type Financial Freeman.
Don't do that, please.
To Facebook, Instagram, TikTok, Twitter. Are we on Twitter?
Not really.
Oh, we're not on Twitter. Oh, we're not on Twitter.
No, maybe we're.
YouTube.
Yeah.
And Spotify.
Good. Until next week.
Bye.
Bye bye.